Okay, hello everybody and welcome back on 99 Media. Today I'm back with Paolo, interviewing our usual guest, Michael Roberts. Hello everybody.
Hi.
So today the topic of conversation is basically sparkles from a recent news happening in the US, where Donald Trump has tried to, I would say, take advantage of a scandal regarding one of the members of the board of governors of the Federal Reserve, Lisa Cook, who basically apparently allegedly got involved in a scandal with, I don't really recall if it was something to do with not paying stamp duty or some sort of mishaps of tax avoidance. And well, the story though is that this Lisa Cook, together with other members of the board, there are 7 members, was against Trump's suggestion to lower interest rates as a way to achieve some sort of policy goals. We're going to discuss about whether that will actually make sense later on. But basically, the attempt is to build up on this so-called scandal to force a substitution of this representative with another guy. And I mean, the rumor is that possibly Scott Bessent could even be the guy that will substitute Lisa Cook if this attempt succeeds. This has sort of like created a plethora of sort of like outrage declarations by I don't know, the traditional finance sector, saying that this move is a direct threat to the so-called central bank independence. And I think that, linking to one of the articles of Michael recently, this is the concept though that we really have to investigate to first of all understand if it is really so important as it is claimed to be, and maybe as a second order of consideration, whether we will see Trump's attempt with some sort of sympathy, or even that might be an instrumental attempt that might not go in the direction that we would hope. So first of all, Michael, if you could explain to us maybe even what is a central bank before what is central bank independence, and when does this central bank independence become so important in recent history, really, because it wasn't always so key.
Well, everybody knows what banks are. You've put their money in your bank, where your salary, your wage ends up in the bank. Everything goes through the banks these days. You can get a loan from a bank, and banks, we know also, probably the viewers know, don't just give us loans or take our deposits. They're out there creating money by trying to make money by lending money to big companies, or engaging in all sorts of advisory activities for commissions in order to get deals for companies and individuals. So we know about the commercial banks. That's what we call them now. But what the central bank is by its name, implies a bank which is centralizing all these commercial banks in some way. And what does it do? Well, the purpose of a commercial bank, as it began probably in the late 17th century in Europe, particularly in the UK and the Netherlands, was to provide a bank that was based on and was funded and could be supported by the state, by the government. And that bank would be, as it were, the lender of last resort. So if the commercial banks got into trouble and they had a big bank run and they started to collapse, and that might have ricocheted through the financial system and brought the economy into serious difficulty, then the central banks could step in and provide funds. It could actually create money, whether it was UK sterling or lira or euro or dollars, in order to support the banks that are getting into trouble. Just 2 years ago, March 2023, a number of regional banks in the US got into trouble. They found that they couldn't fund and support and service the amount of debt that they built up, and they were going bust. The Federal Reserve Bank, which is the America's central bank, stepped in with funding with a special area which they've set up to do that in order to make sure those banks didn't collapse and the system was able to liquefy. It had enough funds in doing so. But of course, in doing so, by creating that, and basically what was happening was that the losses that the commercial banks were making were made up by the central bank, which in effect was providing, in the end, taxpayer money to ensure that happened. So the central bank's primary role to begin with, going back a couple of hundred years, is to back up the commercial banks, to keep the financial system working smoothly in the interests of capitalism and particularly the interests of finance capital. But in the 20th century, it started to play an extra role. It suddenly became central banks started to be used in order to try and manage the economy. They were saying, well, central banks can control the general interest rates being set in an economy. They can set the interest rate for borrowing from them or putting deposits with the central bank, and that interest rate becomes the floor for the whole economy's interest rates. So households borrowing, mortgages or loans, and companies borrowing, what's the interest rate that's going to be working in the market? The central bank can have an influence over that, and by doing so can try to control the real economy, whether people spend more or spend less, whether they invest more or spend less. And in addition, they can also actually change the quantity of money in the economy. They can central banks can add to what the commercial banks have already got by injecting more funds, dollars or euros into the banks directly, buying assets from the banks and directly putting money into the banks in order to try and stimulate the economy is the argument, or on the alternative to take it out to and reduce the amount of money being increased, being produced, and then the result of that tighten up the economy to slow it down. Apparently, this is what central banks can do. Actually, the evidence shows that they can't really do that at all. The real economy, the capitalist economy, functions on different issues for them, which is the profitability of what investments are and how much profits are going to be made out of them, rather than whether just the cost of borrowing involved. And most studies show, despite the claims of central banks, that they really have little impact upon the real economy. We saw that in the case of the Federal Reserve over the last couple of decades, when during the 2010s, they wanted to get inflation up a bit. The inflation was too low. So they lowered the interest rates to zero, they pumped money in, but they couldn't get the inflation up. In the post-pandemic period, we had a big inflation rise. They increased interest rates, they tightened up monetary supply in order to get inflation down. But again, it didn't really have much result. It was only when economies' supply started to going internationally that inflation fell back. So this management of the economy argument for the central banks has not much support, at least in my view, on the evidence. So it remains, central banks are really just there to make sure the financial system stays in one piece. Then the question is, who should control those central banks to ensure that? That's the issue which has appeared in the latter part of the 20th century, where it became, the argument became that central banks shouldn't be under the control of any government, because governments and politicians would interfere corruptly and try to manipulate the central bank to do what the government wants, or that particular government wants, or that particular dictator wants. We can't have that. We want an independent body composed of very eminent economists, superbly expert financial people who could run the central bank in the interests of the banking system as a whole and the economy, so they claim. So we've seen a lot of central banks become so-called independent from the government and the state when they originally were set up by the government and state in some cases, or in others when they were set up by the banks themselves.
Would you agree in saying that monetary policy is kind of like hybrid in its effectivity, in the sense that it might not be capable of forcing lending to happen, because ultimately, as you said, what drives borrowing is profitability, is not necessarily having a low nominal interest rate. But on the other hand, it can be actually quite effective as long as it is ready to bear a recession, of reducing, let's say, inflation. So, because I was thinking about the historical emergence of this idea of the central bank independence, and it was something that was pushed as a reply to the so-called stagflation crisis of the 70s. And actually what then happens is Paul Volcker hiking up interest rates and creating basically a recession to ultimately to destroy organized labor. So I was wondering how you saw these theoretical and historical.
Well, that particular argument about the then head of the Federal Reserve Bank in the United States, Paul Volcker, in the late 70s, early 80s, the argument is that this shows how central bank independence can work, because it managed to get rid of inflation in the 1970s, and even if it led to a recession. I'm not convinced that Paul Volcker delivered the end to inflation by the policy of hiking interest rates. I thought he maintained, as a result of that, a very strong dollar relative to other currencies. But the real thing that broke the inflation rate was the slump in the economy, which was tend to take place, in my view anyway, as a result of the situation we existed in the so-called real economy outside the monetary economy. And that Volcker's policies was really designed to ensure that the currency was strong, and that the financial sector in the US didn't suffer from the slowdown in the economy. But can I say that this independence argument is one which is adopted increasingly in the latter part of the 20th century, because they wanted to free the financial sector from any real control by government and by democratic control of the financial institutions. The Federal Reserve Bank of the United States was set up just after the First World War, after a series of financial panics which nearly brought down a whole load of banks. So they decided to bring this central bank into operation. And who decided? It was other banks. The big banks, JP Morgan and others, came together and said, let's have a central bank. This bank will provide us with a general support if any other bank gets into trouble. The government of the time said, well, you can't just have a central bank on your own. That's completely wrong and independent. The government's got to have some say. So they came up with a compromise position. So the Federal Reserve Bank of the United States is a mix. It's got, as you said, Carla, it's got 7 permanent members of the board who are appointed by the presidents. So that's where the government comes in. But they're in for 14 years. So once they're appointed, they're almost in there as long as a Supreme Court judge in the United States who's in for life. And then they have another 5 from the Federal Reserve's regional banks. So there's 12 regional banks that make up the whole federal bank system. And they alternate as having a vote on whether interest rates should be raised or lowered. Those regional banks are entirely private. They are run by the regional banks or sections of the big banks in America in those particular regions. There's no state appointments or control of the Kansas City Fed or the Richmond Fed. They are completely private central banks connected to this federal board. So it's a mix that's been established. Now, what we have now is an attempt by Trump to remove some of the Federal Reserve board members because they and the chief of the Federal Reserve, Jay Powell, has not been reducing interest rates as fast as Trump wants. Trump wants the interest rates down because there's a massive deficit in the government. The debt's rising. The cost of debt will rise if interest rates stay high. He wants that reduced. He also sees that as a way of boosting the economy, which he's obviously concerned to maintain. And Jay Powell is not prepared to do this as quickly as Trump wants. So he's already appointed one person who came up for vacancy onto the board. He was looking to get rid of one of the recalcitrant Fed board members, Lisa Cook, by this maneuver and replace her. And down the road, because Jay Powell has to go, his term ends next year, he's going to replace Jay Powell with his own appointee, which, as you said, Carlo, could actually be the Treasury Secretary Besant himself. So, and apparently Besant says, I'll stay as Treasury Secretary and be on the board. That shows you the way in which Trump is moving towards controlling it.
If I may interject,
Yeah.
I have two questions connected based on two things that you said in your description of the central banks. The first thing is when you said that central banks are the last lender, right, of money. So my question is, where do they take the money from? How do they have this money? Where does this money come from originally? Unless they create money ex nihilo like God. I don't know, it could be. And the second question connected to this goes back to what you said at the end, namely that the question is who controls these central banks. So today, in the so-called collective West, who is in control of these institutions, and how do they get control of the money that these institutions have at their disposal?
Well, the first question is that what is money? Before the last couple of hundred years, money used to be actually a physical thing almost, gold or silver. We had gold ingots or silver, and those gold ingots or silver could be regarded as having a certain level of value in them, incorporated by the work that's put to get hold of them and put them into banks and vaults and so on. And they were regarded and trusted, that's the point, by everybody as being worth something, a gold ingot. But gold, there's only a limited supply of gold in the world. And as economies expand, demand for more transactions, demand for more money rises. Gold on its own will be insufficient to provide the sufficient supply to meet the value that's being created and the demand for transactions. So, and governments then moved on to what we call fiat currency. In other words, they developed to begin with coins and then paper currency like dollars and euros. And of course, now we don't even have paper really. It's all just digital or in the deposits and accounts of institutions. But if it's just like that, then that means that the central bank and the state can say, well, we're going to increase the number of dollars, and we just add by a computer stroke into all the bank's deposits, their reserve accounts, a large sum of money, billions if you want to. Why would they want to do that? Because they want the banks then to lend that on, to spend that, move it on into the real economy to try and boost the economy, or to keep down the cost of borrowing money because there's now a load more money. So money becomes just a digital currency, which is in the hands of the central bank. And if behind that, if it's controlled by the government, in the hands of the government to boost the economy or to reduce the inflation in the economy, the alternative way around. That's the idea behind it. So we have a fiat economy now, a fiat currency economy throughout the world. Gold becomes just a minor part of the reserves which banks have internationally, including central banks. And the major part that banks have now internationally in central banks are digital or fiat currencies. So that's what money is. And that the question then still remains the same. Who is going to decide whether money is going to be injected, whether it's getting more gold or whether it's injecting digital currency into the banks, or who's not going to decide that? And at the moment, increasingly in the second half of the 20th century, it's supposedly going to be decided by independent experts who sit on these central banks, and that they are not under the influence of governments to stop them. But what they are under the influence of is the rest of the financial sector, the big banks and so on. And that's the point, that the control of central banks is apparently independent, but it's not really independent. It is dependent on meeting the needs of the financial sector, which was originally what it was set up for. And so now they've got a certain independence. The government is not allowed to interfere in a so-called central bank independent system, but the financial sector will make sure that the central bank does what it wants. In the great global financial crash of 2008, the central banks were there to pump money in, digital money, into the banks to ensure that they didn't collapse. or make a decision about whether they did. One of the biggest banks that collapsed during the global financial crash was Lehman Brothers, which was a big investment bank. Now, who made the decision not to keep Lehman Brothers going? Not the government. No, the government didn't make the decision. The head of the central bank, Ben Bernanke at the time, with the rest of the Federal Board and other banks, met and decided they weren't going to save Lehman's. That's an indication of who was really in control of the financial sector. So what we have is a system where the central bank is operating in the interest of the financial system as they see it, and not in the interest even of the government sometimes, and certainly not in the interests of the wider population and people in general. Can we have a democratic central bank? I think we could. There's absolutely no reason why the board of the central banks can't be elected, appointed by an elected government or by parliament or by the Congress, not just by appointees like the president we have in the US or elsewhere. Or in the case of the ECB, there is no election whatsoever for any of the members of the European Central Bank. So we could have a democratic system which would give some control for the people over what central banks are doing in the finance sector. But of course, we do not have that. And we're told by all the mainstream economists after this recent attempt by Trump, what a shock and a horror it is that the independence of the central bank could be threatened when all these wonderfully great and good experts sitting on the central board would be under threat for doing things against the interests of what? Against the interest of who? Against the interest of the financial sector, as far as I'm concerned.
So thank you for your answers. If one were to use terms that are, let's use this word, demystified, one could say that independence of the central banks stands in reality for the freedom of an interest group to do what is more convenient to their pockets, basically.
Dead right, Paolo. That's exactly it. In our real world, there's no independence, is it? There's all interdependence, and nothing is independent and sits above. Maybe God does, but I'll leave you to decide whether he's around. But assuming that God's not there, then we're all interdependent and connected to each other. The question is, who connects to whom, and who should make these decisions? And at the moment, central bank independence, as far as the mainstream economists are concerned, and the great and the good, means independence from the people in order to meet the needs of the financial sector. That's the special interest group, even against government if necessary, which is what Trump is fed up with. He wants a different sort of independence. It's called the Trump independence. He does anything he wants, and nobody else stops him.
Yeah, I think it's really important to emphasize the fact that, you know, we are by no means in criticizing the central bank independence. We are, in a way, elevating Trump's attempt and defending what he is trying to do. Because I think it would be quite a good parallel to see the difference, the different objective of Trump from the one that historically was the one of, let's say, more social democratic governments in Europe in the 1970s and 80s. So, for example, in Italy, I don't know, I'm asking you if you see this as something that makes sense. The dependence from the treasury of the central bank was done to, for example, pursue policies such as wages that were automatically adapted to inflation. So this type of dependence was ultimately determined by policies that favored labor over capital, whereas what Trump is ultimately proposing right now is just whatever he thinks might help him, in his... there's an argument that he might try to create economic boost.
Yes, I'm sure that's what he wants. Yeah. And also you could say before that, what we like to call in these sorts of discussions and amongst leftist economies, the neoliberal period. The neoliberal period is when they're trying to manage the economy better in the interests of labor, manage capitalism better in the interests of labor. That used to be the social democratic position from the post-war period up until the late 1970s. After that, we entered what we call the neoliberal period, which means going back to a period which existed before when there was no attempt to operate governments in the interests of labour. It was a free market, and capitalism was raw and could do what it wanted. So in the neoliberal period, we got rid of government management of the economy. We deregulated the economy. That means freeing up markets and ending trade unions, increasing privatization, shifting manufacturing abroad in globalization. This was the great neoliberal period. And part of that period was to establish the independence of the central bank, as they see it, to get the central bank out of the control of governments that tried to manage it in the interest maybe of people, or maybe not, but not in the interest of the financial sector, which is what central bank independence means as far as the second half of the 20th century is concerned and the people involved. So the big shock now, here 25 years into the 21st century from Trump, is an attempt to reverse that, not to go back to some sort of, in the interest of labour, some sort of democratic control of banks in the interest of labour, but in the interest of Trump's own ambition to become the new Bonapartist American president of the 21st century. But it shocked the mainstream that anybody would suggest that the central bank should lose its independence, in quotes.
Can I ask you another question on who do you think are the factions of American capital that will benefit from lowering interest rates? Because if I understand how the creation of money now operates, it normally works in repo markets.
Yeah.
And the holders of liquidity, which are largely impersonated by the asset manager companies, are on the lending side. So for them, high interest rates are actually good. It's similar to the old commercial versus investment bank divide, where the commercial banks were profiting on the margin of interest between deposits and the interest at which they were lending. Now it operates in repo markets. But I've got the feeling that on one hand, we have a more traditional, let's say, democratic leaning financial sector, which is impersonated by the big threes that actually don't really mind high interest rates. They have got plenty of liquidity. They don't really need it. But I'm interested in who is instead in need of liquidity.
Well, the people who are in need of, or the sections of society that are in need of lower interest rates, are quite undoubtedly households. Mortgage rates in the US, for example, are 7% plus. So even though inflation is around about 3%, that's a real interest rate on mortgages, which is crippling for many people in America. And that something similar applies also in Europe as well. So first of all, households will benefit from lower interest rates, but also particularly a whole swathe of companies, particularly small to middle-sized companies who've got big debts, can't really make enough profits to service those debts effectively. Lower interest rates would definitely help them. On the other hand, of course, if those sections don't actually produce a great deal more value in the economy, and to take the economy forward with increased productivity, more value, then the risk is that pumping money in by lowering interest rates or putting money into the system to try and get interest rates down will only increase the inflationary spiral, which still is not dealt with by central banks in the US and elsewhere. So it's a battle between those sectors who would like to see interest rates lower, which are generally people outside the banking system, and also speculators who like to have low interest rates to borrow because they can borrow on the margin at low interest rates and invest in equities. So every time interest rates look like coming down, we see a big rise in the stock market in the US. On the other side, you've got the financial sector on the whole, which, as you say, is really the lender, and they want a better and higher interest rate, particularly those that lend money by perhaps buying corporate bonds or government bonds. So they want higher interest rates there so that they can get a good return on that. So every time the central bank says it's not going to cut interest rates and it's aiming to keep inflation down to do so, then the bond market improves, because the bond market, the bond investors feel they're getting a bit more confident they're going to get a real interest rate return. So, for example, if mortgage rates are 4% in real terms at the moment, if you lower interest rates by 2 or 3%, then the bond markets and the mortgage lenders are going to be losing money. So they don't want to do that. So there's the division between, and that division expresses the division or contradiction in the American economy at the moment between, is the American economy going into slump and stagnation and recession, or is the American economy going to continue to have or increase inflation? If you do one thing, will it lead to the other? This is the contradiction which we haven't really seen since the late 1970s when you were talking about Paul Volcker again. This is the new situation for the American economy. Trump stands on one side for his own personal interests, and the financial sector stands on the other side for their interests in preserving the gains that they can make out of the financial system and interest rates.
If I might connect to what you're just explaining now, in reference to the current critical situation of the American economy, in which they are in dire need of investments to keep up their enormous debt on the one hand, but on the other hand, they're also in need of the real economy to restart for production, industry, and so on and so forth. So it seems to me that what you're saying points out to a radical contradiction between these two needs, right? So if the big lenders not having a seizable return in terms of interest decide not to lend money to the US economy, what is that going to mean for the US in the short terms?
Yes, well, if first of all, there's the question of if lenders don't want to lend money or discouraged from lending, like obviously they're always lending money, but lending not enough maybe, or they don't feel that they want to do it at the price which they're being offered, and they want a higher interest rate, which and if they're buying debt from a company, like companies issue a bond or a government issues a bond, they want it cheaper, which means they get a better interest rate. So if lenders are taking that attitude, then the interest rates will rise. That will make it much more difficult for the corporate sector to make investments, and for the government also to meet its own servicing charges of a rising debt. So that's the problem financially. Of course, we have to remember that it's not quite as clear as that, because first of all, there's a sector of the American economy, the tech sector, which is making huge profits at the moment and is able to invest hugely. So they don't care, as Carlo mentioned, about what the interest rate is much. It doesn't worry them too much. But there are large sections of the American corporate sector that do worry about the interest rates. But on the whole, at the moment, I was looking at the figures now, profits in the corporate sector is still relatively good enough to withstand the interest rates, which as they are, and even it probably rise a bit. So my view is that if the Federal Reserve didn't do anything about interest rates and didn't follow Trump's needs, it wouldn't make a huge amount of difference to the state of the economy. What we have to be continually reminding ourselves, in my view, is what's happening to the profitability of American capital. Is it improving? Is the rate of profit slowing down? Are profits rising, or are they slowing down? At the moment, they're chugging along. So I'm not one of those who thinks recession's around the corner yet in the American economy. But on the other hand, if this situation would change, then that contradiction between the need to control inflation and to avoid a slump will intensify.
From a Marxian point of view, would you agree in saying that the conflict is between, let's say, people that are in control of value that has already been validated, and the ones that instead would like the possibility to create new value in a way.
Yeah. Well, the way we would put it, perhaps in Marxist terms, is there's investment that's productive of value, and there's investment which is really extracting value from what has been produced by the productive sector. So you've got an unproductive sector and a productive sector. What is the unproductive sector? Well, viewers will know automatically when you think about it what the unproductive sector is. It's the financial sector, it's the real estate sector, it's a whole layer of services which don't really don't produce any new value. What they do is extract value from the sectors which matter, that do produce value. And the balance between those two sectors is vital to understanding whether an economy is in a healthy state or not. What we've seen in the last 20 years is the real increase in the size of the unproductive sector. A lot of resources, value, if you like, and profits has gone into speculation in the financial sector, into real estate and so on, and less of a share has gone into the productive sector, manufacturing, important new knowledge services, technology, and so on. That division has been damaging to the growth of investment and new value, and therefore people's employment and incomes in all the major economies. Now, that's the contradiction that's before. And you could say that when we were talking about central banks, which way should the central bank operate in this? I'm not sure that it has much power really, but if it does, it would be looking to try and make sure that an economy invests in the direction of the productive sectors rather than into the unproductive sectors. But in my opinion, central banks, particularly in America but elsewhere, spends most of its time trying to ensure that the finance sector and the speculative activity of the stock market and the bond market is functioning properly rather than the real economy.
Can I just ask you one? It's a bit of a fantasy question, but just as a thought experiment. Obviously, in 2007, 2008, the Feds, the central banks of the world, basically bailed out the financial sector. They bought those toxic CDOs that the real estate market managed to create. What could have looked like an alternative system in which the central banks were to bail out not the banks, but maybe the people that had an interest in those assets that ultimately didn't end up in their own ownership. I think Blackstone increased its property of the real estate in the US massively. So could it have been looked like a bailing out or I think in the in the UK, I'm not sure if Corbyn mentioned it, but there was I heard talking about quantitative easing for the people.
Yeah, that's quite a good phrase. Well, I think I would say that I mean, if we think about it, what sort of financial system do we want? In my view, we don't want investment banks. We don't want speculators. They should all be closed down. We don't want the speculation in the stock market. We don't want the speculation in the bond market. We don't want speculation in real estate. What we want are publicly owned banks, democratically controlled by the workers and wider organizations of the people, to provide decent constructed lending facilities for people, households and companies at reasonable rates, and a place to deposit your money with safety, so that you've got the resources that you might need for a rainy day. Banks should play that role. Their role is not to engage in all kinds of speculation in financial and other exotic instruments of finance in order to make big money for the owners and the shareholders of the banks and for the people involved. Hedge funds should be banned. The investment sectors of banks should be closed down. We shouldn't have huge banks like JP Morgan deciding everything. They should be publicly owned so that we can run them in the interests of the economy and the people in general. So in the situation of the 2008 crash, the obvious thing that a democratic socialist government would have done is to take over the banks. The whole bank should be taken over. Why should the government end up with 1.9 trillion added to its government debt in order to bail out the banks? We should have controlled those banks, owned those banks, so that we wouldn't have had to use all that up. And then we would set up a banking system in the interest of the population. That's what should have been done. But of course, we had exactly the opposite. The people paid through increased taxation and cuts in public spending and the austerity program after that for the whole decade, and still are paying for the crash that took place in 2008.
Yeah, I totally agree. Paolo, do you have anything else to say, or we could maybe cut it short here?
I'm done.
Good.
I think this is the right conclusion, because at least we also have something to aim for.
Indeed.
Even though I think that this is something that the normal people will probably just agree with, but we have been scared into thinking that for some, very technical reason, this is either unrealistic or wrong.
Yeah. It's impossible, you see, because they're experts. They know what they're doing. The public shouldn't have any. I mean, when I often listen to people in the movement, both in the UK and elsewhere, they say lots of things like we need to end the monopolies of the water companies, the energy companies. We need public ownership of the railways. I'm talking a bit in British terms here a little. We need proper housing system with a public sector. But the one thing that people always seem to avoid is, why not public ownership of the big banks? Why are we not in control of the banking system? How can we leave that outside our control and expect to improve the economy in the interests of people? Without control of the finance through democratic public control, then we are cut short of our ability to turn things around.
If I can add one thing, the ironic thing in all this situation that we're going through now is that those who are against Trump are crying aloud that what he's doing by undermining the independence of the central bank is de facto destroying democracy. We have described the most undemocratic system that one could think of, but if you destroy the system, you are undemocratic. All right, and Trump is undemocratic, to be sure. But
that is not
there's nothing new in the George Orwell way of talking, is there?
Yes, it's the new language.
All right. Thank you very much. Thank you very much, Michael. Thank you very much, Paolo.
Thank you.
See you soon.
See you soon. Thank you.
See you soon. Bye.
Bye.